3 stocks to buy in December 2018. That's what we're going to talk about today. One in the financial services space, one in tech, specifically the electronics space, and one in the internet technology space. We're going to spend about 3 minutes talking about each idea and why we think they could be very rewarding investments. That's only 3 minutes of your time, and if they work out, they could earn you thousands of dollars. So make sure to watch the entire video. And as we go through each stock, we're also going to mention the prices that we're waiting for them to fall to, where it might become compelling for us to add these stocks to our portfolio. As a reminder, we're not a financial advisor, and you should do your own due diligence before investing. The first stock on our list is Goldman Sachs. Ticker is GS. It's trading at about $200 per share with a market cap of $75 billion. For banks, it's not really meaningful to look at the market valuation with enterprise value, so we'll just leave it as NM here. At the current share price, that's about 8 times FY 2019 PE. Goldman Sachs is the single most prestigious investment bank in the world. So what exactly do they do? How is it different from the regular retail banks, where we can just go in and deposit money? Let's look at how the firm makes money. Goldman Sachs has 4 main business lines: investment banking, institutional client services, investment management, and investing and lending. Let's talk about each one. Goldman's investment banking business provides advisory services to large corporations to help them raise capital. So for example, if Verizon needs to borrow $10 billion, they'd go to Goldman Sachs, and Goldman will put together the debt financing package, and in return, Verizon will pay Goldman Sachs a big financing fee. The investment banking division also provides mergers and acquisitions advisory service, where they help businesses buy and sell other businesses. So for example, when Amazon bought Whole Foods, they engaged Goldman Sachs as their financial advisor. Corporations pay Goldman fees for this advisory. The institutional client services business helps clients around the world execute trading transactions. So when large institutional investors need to buy and sell stocks worth tens or hundreds of millions of dollars, they need Goldman to execute the trades on their behalf. This is above and beyond the capability of the stockbrokers that most retail investors use. These could be trades for highly liquid markets like US Treasury and S&P 500 stocks, or illiquid capital markets like small company bonds. They earn fees and commissions for executing these transactions. The bank also publishes research reports on over 3,000 public companies and 40 economies that they share with clients. The investment management business provides investment and wealth advisory services to help GS clients preserve their money and even grow their money. Many American families have a personal wealth advisor. Goldman does the same thing, but just for institutions and families with tens of millions of dollars. And finally, they have an investing and lending business, where they use Goldman's own money to make investments in other businesses. When these investments go well, they'll make a ton of money. Goldman famously invested in Uber when it was still a relatively small company, which earned it a huge profit. So that's how Goldman makes money. We think Goldman is a fantastic business with a tremendous economic moat. First of all 4 of Goldman's revenue streams require an incredible rolodex of corporate relationships. Goldman built that up over 150 years of high-quality client service. This created a highly prestigious brand image that clients equate with the best-in-class service. Because corporations are dealing with hundreds of millions and even billions of dollars, the stakes for them are really high. So they want to pick the best investment bank. Second, Goldman's businesses require a significant amount of capital to operate. Good luck trying to beat Goldman's global scale and comprehensive solution with just a few $million. Anyone who wants to seriously challenge Goldman would need billions of dollars. And finally, there's lots of technical expertise required to execute the types of services that Goldman provides. That technical know-how is spread across thousands of employees. It's really difficult for new entrants to develop the same level of expertise without going through a lengthy learning curve themselves. So we think Goldman is a fantastic business. GS is a great stock to watch for December. It's running into some trouble now with the Malaysia corruption scandal, which caused a big drop in stock price. Basically what happened was that some of Goldman's bankers in Southeast Asia helped raise $6.5 billion for the Malaysian government's 1MDB fund, but $4.5 billion of that money was siphoned off by conspirators to pay for jewelry, art, bribery, etc. The United States Justice Department has opened an investigation into Goldman's role in the conspiracy. it roiled the Goldman stock price, and the stock dropped from the 230s to about $200. We think the market is overreacting, and any further declines is only making Goldman cheaper. The stock price can fall further as media continues to report on the news. If it falls below 190, it could become a pretty interesting investment opportunity. By the way, this video is part of a series that we do every month, where we try to show you more attractive stocks that might not be on your radar. So if you're new to our channel, consider subscribing if you want to hear more stock ideas from us. Our second stock for December 2018 is the technology powerhouse Apple. Ticker is AAPL. It's trading at about $190 per share with a market cap of $920 billion and enterprise value of $1 trillion. That's about 13 times FY 2019 PE, which is a pretty low multiple for a high-quality business growing by over 10% year over year. Apple is one of the best return stories in the stock market. Over the last 20 years, Apple generated over 13,000% of return for shareholders just from stock price increases, compared to about only 120% for the broader S&P 500. That's about 108 times the market returns and a reflection of Apple's superior business quality. This is a business that really needs no introduction, so we're not going to delve into what Apple does or how it makes money. Its iPhone, iPads, iMac, iWatches are revolutionary. So instead, let's talk about what's going on with Apple and why it's an interesting stock to watch for December. Recently, Apple stock took a nosedive and dropped from $220 per share to $190. Why did this happen? A number of reasons. First, Apple guided holiday sales forecast lower than what the market was expecting. In other words, Apple told the market that it's not going to make as much money as Wall Street is expecting for the remainder of 2018. Naturally, the stock price took a hit. Second, Apple said it will stop reporting the unit sales numbers for iPhones, iPad, and Mac from next quarter onwards. This eliminates a key performance metric that it has provided since the 1980s. This signaled to the market that Apple has something to hide and that it's not selling as many products as what some people are forecasting. When Steve Jobs took a swipe at Amazon's Kindle in 2009, he pointed to the online retailer's decision not to report unit sales of its reading device as evidence it wasn't selling many. Apple, following a similar path in 2019, is raising red flags among investors. And finally, Apple's suppliers reduced their forecast for their next reporting periods, essentially guiding the market that they're not expecting to make as much money as they previously thought. If the suppliers aren't making as much money, this means they're not selling as much supplies to Apple, which means Apple is not selling as many iPhones, iPads, and Macs as previously thought. All of this contributed to a big drop in stock price from the 220s to about 190. And it can drop even further, which makes Apple an interesting stock to watch in December 2018. If it drops below 160, we think that could potentially be a great bargain. By the way, for those of you who are not familiar with what we do here at Lumovest, we are an investment education company that teaches the general public how to invest like professionals at hedge funds and private equity firms. If you'd like to learn more about us, visit our website at www.lumovest.com. The third stock on our list is Momo. Ticker is MOMO. It's trading at about $33 per share, with a market cap of $7 billion and enterprise value of $6 billion. That's about 10 times FY 2019 PE. Momo is a Chinese mobile-based social networking company. It allows users to expand social relationships and meet new people through its various functionalities. It also owns Tantan, which is the Chinese version of Tinder. It has over 100 million monthly active users. To put things in perspective, Twitter only has 300 million monthly active users. It's projected to triple last year's EPS in 2018, so it's growing at a really high rate. It's also already levered-free cash flow generative. Said another way, Momo has the high growth characteristic of hot technology companies, but also the cash flow generative capability of a stable business, which makes its current 10 times FY 2019 PE potentially a steal. But that's not all. Also embedded within the $7 billion is about $1 billion of cash and marketable securities. When we're buying a stock, we're not only getting a stake in the underlying business operations, but also a stake in the company's cash and investments. So if we strip out the value assigned to cash and investments, we're really paying less than 9 times FY 2019 PE for a highly free cash flow generative business growing at double-digit rates. That's a big steal. Momo stock has been facing some headwinds recently. With the US-China trade tensions, Momo doesn't really have much exposure to the trade tension, to be honest, but its stock generally moves in line with the broader Chinese internet stocks, many of which are e-commerce companies that are exposed to the trade tension. So in a way, it's just collateral damage, which makes it cheaper and cheaper. We're keeping it on our watch list, and we'll be taking a stake if it ever falls below $30 per share. So these are our 3 stock picks for December: Goldman Sachs, Apple, and Momo. Are you planning to buy any of these stocks? We'd love to hear your thoughts, so drop us a note in the comment section. Also, share with your friends and family so they can join you buying some great stocks. As a reminder, you should do your own research before you invest in anything. If you want to learn more about stock analysis, subscribe to this channel and check out the courses on our website at www.lumovest.com. See you guys next time.